There's a dangerous temptation that's facing investors right now based on a call that I received, and I thought this would be a good question to answer through a video. If we look at the Dalbar numbers, Dalbar does research out of Boston in regards to what investors are actually getting investing in the stock market and various other markets. And what they've found over the past 30 years, the average investor in the stock market made about 4% per year is what they estimate. Now, the market, large U.S. stocks, averaged just under 10% over the same period of time. The average asset allocation investor investing in stocks, bonds, and cash, less than 2% per year over that period of time. The average bond investor barely over break even during that period of time. Now, just to put those in numbers for you, $30,000 invested in large U.S. stocks grew to over $500,000. Literally about 1/5 of that in the average equity mutual fund. Now, the average asset allocation investor, even worse, about 1/10 of that amount of money over that period of time. Now, if we look at returns going back to 1982, we have all these different asset categories that we would use in a portfolio, and this is where the data starts on all of it is 1982. That's why I'm using this particular period of time. You notice that the far left bar is large U.S. stocks. All these other areas like large, small value, international large, international small, all these other asset categories, most of them have higher returns actually than the S&P over that period of time. The two lower returning categories are the ones that most Americans tend to invest in, large U.S. and large international. Those are the lowest bars on this particular chart. Now, if we look at from 2000 to 2008, we see that the S&P 500, the first bar over the far left, actually lost money. So we can see that it was a really good idea to be diversified amongst all of the different asset categories during that period of time. How about 2000 to 2018? Again, well, they didn't lose money, but it was really good idea to be diversified amongst all of those asset categories, as you can see. How about the last 5 years, 2014 through 2018? Now we see a different story. Large U.S. stocks did better. So that tells you that's why we still own the asset category. They can do better. But if we look at the prices of these companies compared to book value, the assets of the companies minus liabilities, we see that the bar over the far left, which is large U.S., is higher than everything else. So that begs the question, is it time to buy more U.S. large? Well, I think you can answer that question for yourself. Number one, it breaks the rule of investing, which is the golden rule, which is buy low, sell high if we do that. But that's what a lot of people tend to do. They chase yesterday's winners. How about the other rule of investing, which is that we diversify the portfolio? It also breaks that rule. Well, what we often want to do is change strategies at the absolute worst times as investors. Why? Because we're impatient. I can't wait for this thing to go up. Or emotions kick in, or maybe our instincts kick in, which is, go away from pain and go toward pleasure. And we have this little saying, it's called I plus E, which is our instincts plus our emotions tend to be magnified by the media and the investing marketing machine. They tend to outweigh or are greater than the cognitive side. Our goal here is to teach you, help you to understand these things, because the more you can build up your brain, the less these things become a problem, which are the things that actually cause problems for investors long run, as you can tell.